Take a look at this chart. It shows us the comparison between the euphoria of the 2008 market crash with the AI bubble in 2025, the Bitcoin bubble of 2017, and the housing bubble of 2005 using Google search trends. What's interesting about this chart is the dates of those peaks. August of 2005 was the exact moment the housing market began to roll over. And this spike for Bitcoin, it happened in December of 2017, the same month where Bitcoin peaked and then went on to drop by 80%. Today, the interest in the AI bubble is now exceeding what we saw in those same situations. Michael Burry, the famous investor who shorted the housing market in 2007, has told the world that he's shorting two of the most AI-related stocks in 2025, Nvidia and Palantir. There's an obvious reason for why the risk in the AI market has just increased so dramatically. But the truth is, the US government and the US Federal Reserve will not allow this market crash to happen. In November, the president of the New York Federal Reserve, John Williams, quietly said the part out loud. The Fed is going to grow its balance sheet again, soon.
I fully supported the FOMC's decisions to reduce the target range for the federal funds rate by 25 basis points at each of its past two meetings. I view monetary policy as being modestly restrictive, although somewhat less so than before our recent actions. Therefore, I still see room for a further adjustment in the near term to the target range for the federal funds rate to move the stance of policy closer to the range of neutral.
That's the diplomatic way of saying it's almost time to turn the money printers back on. That moment is far more important than people realize. The last time this happened, it triggered one of the biggest bull markets in modern history. In 2026, the midterm elections are right around the corner, and the Federal Reserve is setting the stage for what may be the most explosive melt-up of the decade, because the plumbing behind the entire financial system is about to burst. So today, I want to show you why the Fed is preparing to unleash the money printer and why it's happening earlier than expected, and what this means for markets over the next 2 years. I want you to take a look at the current financial system, just like a plumbing system. When the Fed shrinks its balance sheet, this is what they call quantitative tightening, or QT for short. They're not just fighting inflation, as they say, they're draining the excess wastewater of the financial system. In this case, that excess wastewater is liquidity. Banks operate on reserves, money markets run on collateral, and the repo system needs a constant flow of liquidity to function. For 3 years, the Fed has been draining that system, pulling nearly $2.3 trillion of liquidity out of the pipes. But here's the problem. Reserves are falling faster than the Fed expected. And if they fall too far, the entire financial system seizes up. Just like 2008, just like 2020, and just like the repo scare earlier this year. When repo rates spike, the pipes clog up. When the pipes clog up, the banks stop lending. And when the banks stop lending, the economy stops breathing. This isn't optional. This isn't a philosophical debate. It doesn't matter whether you agree on it or not. This is the way the system works today. The Fed must step in. And that's exactly what's happening now. On December 10th, it's expected that QT will officially end. Done, finished. And the next step is QE, quantitative easing. But they'll never say this plainly. They'll use terms like balance sheet expansion, asset purchases, liquidity injections, but in plain English, it's money printing. John Williams said it directly. I expect it's not going to be long before the reserves will need to grow again. Jerome Powell said it in October. He said, and I quote,
"But at a certain point, you'll want to start reserves to start gradually growing to keep up with, the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point."
Dallas Fed President Lori Logan said it even more bluntly. If repo rates continue rising, the Federal Reserve will need to begin buying back assets. All three of them are saying the same thing without actually calling it QE. Why? Because they don't want the markets to panic. They don't want inflation expectations to spike. And they don't want to make it look like they're stimulating the economy right before an election cycle. But the reality is simple. The system is running low on liquidity, and the Fed has to refill the tank. Whether the public understands it or not, QE is coming back. And oddly enough, Jerome Powell's term ends in May of 2026, and the person who gets to choose the next Fed chair? You guessed it, none other than Donald J. Trump. Trump has made his position very clear. Interest rates are too high, and the Fed is too slow with their interest rate cuts.
You talked about removing him once.
I did, because he was keeping the rates too high. I think I have the right to say I think you should go up or down a little bit.
Trump and his advisors believe that America needs a weaker dollar to boost exports and lower interest rates to boost borrowing demand. Trump wants a Fed chair who agrees with this premise. That means one thing. The next Fed chair will be in favor of more economic growth through lower interest rates, aka easy money. Lower rates, more tolerance for inflation, more willingness to cut, more willingness to support growth at all costs. You can already feel the markets pricing this in. A dovish Fed plus new QE plus election year liquidity equals rocket fuel for the markets. Not because the fundamentals or the earnings are strong, but because policy is now aligning with the markets in a way we haven't seen in over a decade. Every time the Fed expands its balance sheet, the outcome is predictable. More liquidity, lower yields on investments, higher valuations, more risk-taking, and eventually, higher inflation. It doesn't matter why they do it. It doesn't matter what they call it. The machine reacts the same way. This is why Ray Dalio said something that should make everyone pause for a minute. He said, and I quote, "The Fed is stimulating a bubble. We already have high stock prices, high inflation, record deficits, speculative valuations, and a market depending on AI hype to survive. And now the Fed is preparing to inject even more liquidity into that environment." Dalio expects what we call a melt-up, a final parabolic surge before the market bubble becomes so large that inflation forces the Fed to slam the brakes. This isn't your normal bull run. This is a late cycle liquidity surge, the most dangerous kind, because everyone thinks it's real and sustainable. Right now, it may not seem that the market will react that way because of the fear and greed index being in extreme fear at the moment. But give it time, and the mood of the investors will change even faster than you think. But before that happens, markets often experience one last explosive rally, the kind of rally that people call irrational, the kind of rally that makes bears look stupid, the kind of rally that no one believes in until it's too late. We're approaching that phase now. So the obvious question is, what do you do with this information? I'll tell you exactly how to approach a melt-up. First, you want to follow liquidity and not the headlines. Second, don't chase the top. Melt-ups don't move in straight lines. You get violent pullbacks inside of an uptrend. Those dips are where smart money enters. If you FOMO in during euphoria, you're likely to get destroyed when the inevitable 15% to 50% correction hits. Ride waves, don't chase peaks. Thirdly, diversify intelligently. In liquidity-driven markets, stocks rise, crypto rise, precious metal rise, and sometimes even junk assets rise. But nobody knows which one will outperform which. If you're a crypto guy, shift into some metals. If you're a gold bug, shift into some equities. Spread the risk across multiple macro themes. Melt-ups reward diversification more than the conviction in one asset. And fourth, avoid margin debt like it's poison. I've seen more people wiped out in melt-ups than in crashes. Not because they bet wrong, but because they borrowed too much. Here's exactly how margin kills you. Let's say you have $10,000. You can borrow enough to control $30,000 in assets. If those assets just drop 33% during a pullback, your entire 10K is gone, wiped out. The market recovers, but then you have nothing left to participate with. Now here's the part nobody wants to talk about. Even though Ray Dalio practically screamed it, every melt-up ends with a meltdown. Why? Because liquidity creates inflation. Inflation forces the Fed to slam the brakes. And when the brakes are slammed, the over-leveraged markets fall apart. This cycle is no different. We're going to melt up, and then we're going to face a reckoning. The timing depends on, number one, how fast QE ramps up, who replaces Jerome Powell, how strong inflation rebounds, how bad the unemployment situation is, and how disciplined Congress is. Hint, they're not very disciplined. But one thing is certain, the next 18 months will not be normal. We're heading into the most liquidity-heavy period since 2020, without a crisis to justify it. The Fed doesn't want to melt up, they're just trying to keep the financial plumbing system alive. But when the Fed expands its balance sheet, markets don't ask why, they just move. And once the liquidity starts flowing again, especially in an election year, it becomes impossible to stop. That's why 2026 may become the most unexpectedly bullish year of the decade. Not because the real economy is strong, but because the system is fragile. And Trump and the Fed will refuse to let it die. Liquidity, not fundamentals, are about to take control. But once again, this has been your boy A-Cole. Hopefully you get it, you got it, you learned something, you're good, and I'll talk to you in the next one.